SentinelOne IPO'd at $45. Today, it is struggling near $17. But what is under the hood? What does the balance sheet of the company say? Does it have a lot of cash? Does it have any debt? Is there any real growth? Is it a forgotten gem? Or is it a trap dressed up like a tech stock? Let's take a closer look at SentinelOne today. Welcome to Balance Sheet Investing. This is a channel where we decode companies using real data, not just Reddit rumors. If you're into fundamentals, financials, free cash flows, and if you're really into data-driven investing, do hit that subscribe button. Before we begin, a quick disclaimer. This isn't financial advice. This is just one passionate investor sharing my process with you. Please always do your own research before you invest in. So, what does SentinelOne do? Imagine that your computer or your phone is like your house. You've got doors, think of apps. You've got windows, think of internet browsers. And maybe even a few open cracks. Think of the sketchy free downloads. Now, hackers are like burglars trying to sneak in. Most security systems, what they do is that they are like security guards. They will monitor the door, the windows, and if they see something suspicious, they will try and contact the human. SentinelOne, however, is like an AI robot. If it sees that something is not right, something is not aligned with how you typically behave, it would automatically take action and throw the burglar out. So it kind of acts on its own without having to contact a human being. And that is something which typically companies and big enterprises are willing to pay a lot of money for. The cybersecurity market, according to a number of different reports, is going to grow to almost like 287 billion by 2027. The total addressable market for SentinelOne is quite big, and SentinelOne is riding this wave. Let's take a look at what's under the hood for SentinelOne. Let's look at what does the balance sheet indicate. So as you can see here, SentinelOne has almost $767 million in cash and cash equivalent. Look at the trend here. In 2021, they had about $395 million in cash, whereas in the trailing 12 months at the end of April 30th, 2025, they have about $767 million. That's a really good jump. That's almost double in 4 years. If we take a look at their total assets, the total assets have also grown multifold in this period. Their long-term debt is negligible. So basically it is a cash-rich company and has no long-term debt. Now that sounds like a really good scenario. From a balance sheet perspective, this stock looks really good. If there were a recession, I don't foresee any major concerns for SentinelOne. Let's take a look at how revenues are performing. In FY 2021, the revenue was 93 million, which has grown to almost 8 or 9 times to 864 million. The gross margins for SentinelOne have grown from about 57.73% in FY 21 all the way to 74.8% in the trailing 12 months. This means that SentinelOne is able to charge its customers more money for its products, which clearly indicates a bit of a moat status. The free cash flow margins went from negative 75% in FY 21 all the way to positive 5% in the trailing 12 months. But that's not all. In the latest quarter, their free cash flow margin was 22.76%. For a company that is generating almost 75-76% gross margins, there is room for improvement so far as the free cash flow margins are concerned. The free cash flow margins can grow as high as 35 to 40% for a company with a gross margin of about 76%. If they hit a 30% free cash flow margin, then they really become a cash cow. Now let's take a look at the valuation. At the time of the IPO, they were priced close to 60 times revenue. Today, it's just 6.5 times. However, let's not purely focus on the sales multiple. Let's talk about free cash flows. So, right now, the price to free cash flow is about 134 times. That might sound really high. However, SentinelOne is not yet optimized fully for free cash flow margins. What does that mean? If SentinelOne, which has already produced almost 23% free cash flow margins, can improve over the next few quarters to up to 30% free cash flow margins, then the valuation actually drops down to just 19 times free cash flow. Think about it for a moment. A company that is growing in the mid 20s and it's priced at just in the late teens from a market cap to free cash flow perspective. That to me looks really attractively valued. So, what am I doing? Personally, I'm starting a small position in SentinelOne. If they execute well over the next few quarters, they deliver strong margins, consistent growth, the free cash flows are trending in the right direction, I'll scale my position to about 5% of my total portfolio. But hey, that's my conviction. What about you? Let me know in the comment section below what you think about SentinelOne. Is it a buy? Is it a hold? Is it a pass? Also, do let me know what other stock would you want me to give a deep dive into. If you found this video useful, please do smash that like button and subscribe for more deep dives like this every week. Thanks for watching and stay data driven.